Well, hi everybody. It's Akhil Patel and Andy Pancholi here today. It is Friday, the 11th of July, 2025. We're both in the UK, and this is really impromptu. We thought we'd do a fireside chat, but then, as Akhil pointed out, it is 30 degrees here. For those of you in America, that makes it what over 28 to 82, so it's well into the 80 degrees. And I treated myself to air conditioning for my office. But anyway, enough of that. So it's not a fireside chat, is it? In fact, as Akhil said, a barbecue chat. So the reason we've got together really was because we were just grabbing a glass of wine or a beer or something up in London 2 days ago at the Society for the Technical Analysts. But also we were hanging around in New York at the Foundation for the Study of Cycles. And as ever, we have so much to talk to each other about. We've done a lot of that already, but we thought we'd do a bit more and share it with you all. So, Akhil, good to see you. It's only 2 days since I last saw you, and 2 weeks since we were hanging around in New York. But yeah, so what should we do? Should we do something like fire? Well, except fireside chat, just an update. How about a mid-year
Yeah,
update? Why don't you go first and let me know your thoughts? I know we discussed some of them. We had some good discussions and some
yeah,
agreement, and also parallel views. So yeah, fire away. What are you seeing, mate?
yeah. Well, Andy, always good to spend time with you, both professionally and socially. Had a great time over a glass of wine in New York, and also a couple of days ago at the STA meeting. So yeah, I think when we last spoke, I think it was right at the beginning of January. It was just before the inauguration or something, and we were talking about the outlook for 2025. I think, we're expecting quite a bit of turbulence related to the new administration's policies. We thought it might, there had been quite a strong run up in equity markets into the end of the year. We thought that might at least pause, or there might be some volatility around that. Um, and I think actually were talking about it for over an hour, so we said a lot of other things. I can't remember entirely what we said.
I don't know.
Anyway,
I don't know if anybody listens to us or not, but yeah.
I think a few people do. Anyway, I think all of those things have come to pass. It's been very turbulent, particularly related to kind of the Liberation Day tariff announcements. I think markets weren't quite expecting the extent of the announcements and the way it was done and the rationale for doing it. It seemed to be quite a basic kind of calculation
Yeah.
based on some kind of misconception. But probably that's not really the point. It's not. The point is not to be correct. The point is to be seen to be doing something pretty significant. And certainly the U.S. administration was successful in that regard. Um, but as with all of these things, over time the market gets used to the flow of news and the way that policymakers are going to behave, and they price in a lot of things. And so I think we've seen a lot of that over the second quarter. Now, whether there's going to be some new announcements, we talked about the deadline expiring. That's in some cases been extended. Maybe there'll be some further volatility, but it's, I think, in a sense, looking like the risk that was priced in, which is probably causing markets to come down to take their time in recovering, albeit that it was quite fast recovery in the US equity markets. I think that is potentially starting to disappear, and markets, at least some markets, are looking quite strong at the moment. And so, absent any sort of new kind of, for want of a better word, shit
Beep.
arising, I think things are looking sort of fairly bullish into the third quarter. And that's actually something that I expected when I wrote to my PSE newsletter subscribers at the start of the year. So we wait and see. I mean, these things almost are news driven. So let's see what the next major news announcement is. But I think there has to be something quite different to set investors on edge. There's also the possibility of interest rate cuts of the Federal Reserve. That will be a bit of a boost. And we might want to talk a little bit about interest rates, the falling dollar. I mean, that's generally good for global growth and global trade, and other sort of markets taking the lead. It's also good for US exporters, something the administration wants. So there are some fairly bullish factors. There's also some negative ones which we might come on to, but I'm actually relatively positive for the second half of the year.
Good. Yeah. Well, that sounds interesting. I think so.
Do you think? What do you think? What's your
Yeah.
view?
Well, I was going to say we don't know what to expect, do we? Except,
Well, that's true. That's true.
I mean, the first comment I was going to say was, yeah, looking at the news, and you can see the retail people have disappeared a lot, and from trading, you can definitely see that because the markets are too volatile because you don't know what's going to be said next. But of course, in our world of cycles, it should all be discounted. So I'm going to stick with my original prediction, which was that we would close the year higher because it's a year ending in five. Although we would see some drama before then, and I think that's I'm still holding on to that. We've seen the drama. We saw a very quick recovery, quicker than I expected, to be quite honest.
Yeah,
But
I think that's fair. I think
yeah,
that's fair.
yeah. I mean, yeah. I mean, were you expecting more of a drop there, Akhil, or
I wasn't, to us, I wasn't expecting quite the dramatic drop. I think that was more significant. But given that we did have the drop, the recovery was quite swift. Now, that actually, you mentioned the year ending in five, fifth year of the decade. That might be one of the factors. Things are generally quite sort of bullish for the markets, and maybe that explains the speed of the recovery. But I think I was surprised by the way that the whole tariff situation came about. So I thought it was I've been fairly clear in my views that tariffs are a really bad idea. But then to have been imposed in the way that they were, and with the numbers that they were, particularly with China, given the extent of interlinkages between the two economies, I thought that was sort of fairly ludicrous. But anyway, enough said about that.
I will
Um,
that because one of the things we did talk about was well, actually I popped in the year ahead edition of the market timing report was that if you go back, I'm big on the 45-year cycle and so on, but go back three lots of 45 years, and that took us back to 1819. We saw McKinley bringing in tariffs. In fact,
yeah,
we've laid almost identically there because what happened there was the price of goods internally went up. Well, by the midterms, they've gone up sixfold, for example, with regards to things like tractors, which could only be bought internally. So that was the first thing. And the next thing that happened was that the farmers were so angry they formed the Populist Party, right? So who's talking about a new party right now? And the third thing, which I think we'll have to wait and see how this plays out, but McKinley's administration lost the midterms big time 2 years down the road, and
yeah.
literally 6 months into this administration. So we're only a quarter of the way to the midterm. So I think that's quite important with regards to these tariffs. But yeah, let me throw it back to you. Sorry, I interrupted you there.
No, I don't disagree with any of that. There are some interesting parallels. I think Trump has, if I'm totally honest, I think he has been persuaded by some of his advisors that in the 19th century the US didn't have an income tax, and he must have asked someone, "Well, how do you fund the government?" And they said, "Oh, well, we had this sort of tariff regime, and that's how we did it." Now, 19th century, the 21st century is very different economically. Didn't have nearly the same linkages between countries that we do now. But even so, you'll know that I follow this American economist called Henry George, who kind of first analysed the sort of real estate cycle, and which I follow very strongly. And he was also a big proponent of free trade in the 19th century, and he pointed out that actually the real beneficiaries of tariffs are ultimately landowners. And of course, having a real estate owning president, it becomes a bit, you can see that it's not a policy that's designed for the average person. And actually, maybe that's not the point. It's to enact tax cuts, which have now been enacted, but to find some other way of raising revenue. You supposedly think it's going to be paid for by overseas people. Actually, it's paid for by your own citizens. So it's really quite a regressive policy from the point of view of who's supporting the current administration. So that's kind of my view on it. I think it's totally mistaken, and I think it will come back to haunt the government. Maybe in the midterms, maybe the next election. Certainly, as we get to the end of the 18-year cycle, which I talk about in my newsletter, I think it will be sort of fairly catastrophic.
Sure. Do you have the chart handy there? Let's update everybody on that. So Akil, yeah, 18.6 year cycle. If you've got a chart you can update us with,
Yeah, can you see that?
I can, yeah.
Yeah. Okay. So basically, the way that the cycle, it's an 18-year cycle of boom and bust, and it's all the kind of major booms and bust phases of the economy are sort of encapsulated in the cycle. Um, and it typically manifests itself as kind of 14 years of expansion. So of roughly 7 year halves. So they're the first sort of upward phases of the line there. The first two, that is, interrupted by a mid-cycle slowdown, and that kind of lasts typically 14 years, and then you get a major peak, and then a crisis, and banking crisis, a currency crisis, sovereign debt crisis, something like that, and it takes about 4 years approximately to get out of that kind of process. And you can trace this cycle back in US history and in other countries like the UK well over 200 years. The most recent iteration of a completed cycle was the one that peaked around 2006, 2007. You had the global financial crisis of 2008. It did take quite some time for the recovery to, particularly in the economy and the banking system, to take place. Around 2011, 2012 was when the current cycle started. So if you were counting from there, so roughly 7 years from the start of the cycle, you get the expansion, you get a mid-cycle slowdown towards the end of the decade, around 2019, 2020. We certainly were having a slow, so you would have the stronger second half of the cycle, taking us to a peak around 2026. And what you tend to get in the second half of the cycle is kind of looser monetary policy, big fiscal stimulus, sort of infrastructure spending associated with that, commodities boom. The yellow dot kind of represents where we are now. And it's very much the final couple of years, which is the really sharply sloping line, is sometimes called the mania or the winner's curse phase. This is where you get very significant kind of speculation, a lot of high prices paid for artwork. You've seen some of that in recent days. In fact, this morning there was news of a handbag fetching £7 million at Sotheby's. You had a few million for a banana duct taped to a wall a few months ago. All that kind of stuff, right? You had the biggest musical tour in history with Taylor Swift during 2024. It's that kind of era. And it's somewhat the speculation, the hedonism and somewhat fueled and abetted by very easy money, not necessarily from banks, but also private credit providers. Banks are trying to get rid of regulations and so on. You also get the announcement of the world's tallest building in this kind of phase. Now, the reason for this is that it's a real estate cycle. Once you've had about 12 to 14 years of expansion, land prices are very high. It makes sense to build taller. You've got lots of money sloshing around the system, looking for investment opportunities. These sort of mega projects are some of those, and a unique kind of quite optimistic kind of outlook to conceive of these things. It's no coincidence that the Jeddah Tower was resumed, I think, last year. This is going to be over a kilometer tall, at least 200 meters plus taller than the Burj Khalifa. They're a bit cagey about how tall it's exactly going to be, but it's going to be really massive mega structure. But you're seeing regionally, in the regional sense, in Australia, Australasia's tallest building being announced, and so on. So this is what you expect in the run up to the peak, which we would then expect around 2026, which is 14 years after the start in, I think it's probably early 2012. And that would be the peak. Now, the crash doesn't happen automatically after the peak. There might be a delay of a year or two. But, you're on the lookout for something like that, something to trigger a crisis. And it takes 4 years for that process to play through. And during that time, that very tall building will open and they won't be able to get any tenants into it because no one's can afford to pay the high rents or wants to pay the high rents. And so it remains empty for quite some time. And that process will take about 4 years. So you look to the start of the next cycle in the early 2030s. So that's in a nutshell where we are, and we're actually fairly close to the projected peak of the cycle. So, it's the time where you don't really want to be carried away, getting carried away. You don't want to be borrowing too much. By all means, invest in markets going up. They can go up quite rapidly in this period, but you don't want to be going all in necessarily or over leveraging, and having in mind at protecting some of your capital, because things can turn down quite swiftly.
So yeah, we really are approaching that critical point now, aren't we? So what do you propose people should be doing right now? I guess you said we don't want to be borrowing too much, and what about? D In fact, actually, I had this question thrown at me, and actually, I'll defer it to you because I know you're the expert on this cycle.
No,
Uh,
not.
Stock market and top of this cycle, do they align? I've got a strong view on that, but I'll let you. I just want you to answer this one here. Do they necessarily align? Do we get a top at this in the markets at the same time as we see a top in, say, the housing market or and so on?
Yeah, they align in the sense that you get the land market peaking first, followed by the housing market, followed by anticipated by elements of the stock market, but that kind of process is followed by the broader market peak, um, followed by in many cases commodities. So you kind of get a rolling series of peaks. The US land market as a whole is the initial kind of marker of the peak, but other things may peak afterwards. And you tend to find that residential peaks before commercial. So house prices might start to come down, but you might actually have the continuation of a bit of a boom in commercial real estate. And in fact, that might be some of the capital flowing out of the housing market is going into, data centers or logistics centers or, new types of offices or whatever it is that happens to be the building that's most typical of the new paradigm. So for example, in the 1920s, in the run up to the peak, you had all these sort of Manhattan skyscrapers being built, way above what was needed given demand. But there were sort of various incentives for capital to flow into those assets. You might get something similar with offshore financing of data centers or whatever to support kind of the new AI economy.
So how do you recommend we protect ourselves
We
on
protect
this?
ourselves. Well, I mean, this is a very good question. I get asked a lot, and particularly by my subscribers. The first thing is to make sure you don't overreact. So I'm not saying sell all your property, sell all your thing, go into cash for like 4 years, and so on. I mean, real estate, as you well know, because I think your wife is involved in real estate or used to be involved in real estate. So you well know that you might have really good real estate in your portfolio that actually should keep forever. And also, you don't necessarily think of your house, the one you live in the same way as you would an investment portfolio, for example. But it is the opportunity now to get rid of things that you might want to get rid of, lock in profits at high prices, particularly when people are still able to borrow lots of money to pay for these sorts of things. So you might want to trim, de-risk your portfolio. You might want to be quite tight with some of your stops. You might want to use kind of hedging instruments as you get a bit closer to the peak. You might want to go into ultra defensive stocks and just with pretty stable dividends and take the income where the sort of the drawdown in valuations for a few years. You may want to actually go into high quality liquid assets, government bonds, and collect the interest coupon for a few years. It sort of depends on your circumstances, but those are some of the things that you can do. I think you don't want to be overly exposed to highly speculative assets that don't have any inherent earnings, because the price of those might go very high, but it can come down very hard as well. I'm asked that question. Do you find that convincing, or do you have other things that you might be looking at yourself?
Okay, well, yeah, good question, Akhil. So, my view in the bigger picture, well, first of all, I don't disagree with anything you're saying. Obviously, we know this 18.6 year cycle works pretty much like clockwork. But I like to put this alongside the 90-year cycle.
Right.
Did see, whilst we did see pullbacks, we did see a run up into 1929. Of course, we're approaching the 100-year anniversary of that. And we're also approaching the 90-year anniversary of the outbreak of the Second World War. So I'm wondering if we're going to see quite a lot of volatility coming up. And when you put this against the backdrop of obviously, I look at the super long-term cycles, as I know you guys do, but um, this idea of the 250-year anniversary of America from 1776, which unfortunately in the 18.6-year cycle doesn't tie up at the best of places, but there is this whole idea of changes in empire as we come to this point. You can see how much
Yeah.
America, and so how rapidly it is doing that as well. So in answer to your question, I would say I think we're still fairly bullish into the back end of the decade, but I do think we are likely to see some sharp shocks. And that does in no way negate, it actually supports what you're saying, but using some other cycles there. And I think the wild card is that there is a more I'm going to call it fuzzy because it's a difficult one to time. But we've just entered a period, but it's a big period. It's a big period. It's not just like a few weeks or a few months. It's actually several years. But where the flavor of energy, when you look back historically in that cycle, suggests America is likely to be in global conflict. So
Mm.
got all this stuff coming together, and I mean these really are exciting times for all of us, both as traders, portfolio managers, or cycles analysts, and all the sort of stuff. So. I do think it's very interesting. The other thing I can see coming up is um, we've kind of created an FX matrix here for the major plays over the next 6 years, and the first one of these is coming out in the next few weeks. So I do think that we might see a crisis amongst one of the outlying currencies, which in this case will be the British pound. So I'm thinking we might see some sort of sterling crisis. It is September. We do get them in September when we get,
Yes, we do. Yeah.
we talked about prime ministers and cabbages racing for survival. Well, we're almost in that area again with some pretty
Yeah.
interesting
And there's
management.
the
Yeah,
George Soros trade against the Bank of England
yeah,
and the sterling peg in 92 in September as well, wasn't it?
yeah. So 92, we're going to be 23, 33 years away from that.
Yeah.
So that's happening. So I think that's something to put on your radar. And I think that in itself could kind of create oh, well, nobody expected that black swan nonsense. Or this time it's different, haven't yet to hear that. Uh, the
Yeah,
other thing
indeed.
I'm hearing, and I think this is a point where we'll probably both agree on, is that, well, we've got AI now, so the markets are going off to way beyond the moon. In fact, they're going off to Elon Musk's Mars. They get, because of AI. But of course, that's the latest new technology, and you and I talk about this time and time
Yeah.
again. Matches airplanes, radios,
Yeah.
television, last 100 years, and then more recently,
Mm.
mobile
Yeah.
phones, PCs, you name it. Yeah, sorry, let
Yeah,
me
no.
carry.
So one thing that I noticed, we're talking about sort of the era of easy money, and you just mentioned Elon Musk. So there's this new kind of way of participating in these private companies. It's not by buying shares. It's by owning some tokens issued by the company. There's no kind of voting or governance rights. They're not shares. They're not subject to listing rules or anything like that, or exchange rules. But you can buy and sell them on an exchange, and I guess they give you some kind of right to they're linked to the value of the balance sheet or the value of the company or whatever it is. And so there's some way of participating in the upside of some of these companies. But to my mind, it's a way of some of the owners of these companies cashing in on the high valuations without having to go through the rigmarole of listing them on a stock exchange. So it's interesting. It's kind of it does smack of trying to get retail investors involved in things at high prices when the kind of the big professional investors are trying to realize some of the gains. So I think you have to be quite careful at this moment.
Well, that would tie in with the winner's curse phase, wouldn't it? Really,
It
that's
certainly would, yeah.
sort of a
Yeah.
scammy coming out.
You
Well,
basically want things to be denominated in low values such that everyday investors can participate. You saw the same thing in the 1840s railway boom in the UK. I know it's a slightly esoteric example, but that was the new technology of the day. And the nominal value of the shares was quite low, so that average investors could participate. And in fact, you could participate before a railway scheme was launched by putting down 10%, and so you basically got a 90% loan on acquiring that share. So it's definitely a feature of previous cycles.
Yeah, yeah, no, absolutely. So I think we're certainly exciting times. I'm trying to think. Sterling prices wanted to. Yeah, oil. Any views on oil? And one of the things is we've got the 45-year pattern coming in, as we pointed out in the market timing report, from the prominence of Iran and also Iran versus America. So that cycle has come in like clockwork. If you go back to the Jimmy Carter years and you saw the U.S. hostage crisis at the American embassy in Tehran. Well, we haven't quite got that, but we have seen America directly bombing Iran, and oil moved, except it didn't move. Any thoughts on that one?
I mean, the outlook for oil at the moment is looking fairly negative from a price point of view, isn't it? I mean, everyone seems to want to be producing or pumping oil, regaining market share. US government wants low oil prices. So and the Iran crisis has not had much an effect so far. I suppose it sort of died down a little bit, but they're saying that there was 10% geopolitical risk premium baked into the price of oil, and when nothing more serious, at least so far, has materialized from this Iran-Israel confrontation, that some of that has disappeared. I think I'm probably of the view the outlook for oil isn't particularly strong. Um, but what I am quite interested in is the possibility that that outlook changes quite rapidly, or for a short amount of time, but you get this massive spike in oil prices, at least in relative terms, which might throw other things out, and that would be consistent with the falling dollar, of course. Um, and yeah, and against expectations. In fact, this is what you look out for in the winner's curse phase. The obvious trends, I think, are going to support things moving ahead rather rapidly. I think it's these sort of unforeseen, unexpected developments that happen quite rapidly, which are the things that might bring on the peak and maybe trigger the crisis. And so I'm looking for these sort of quite somewhat contrarian sort of developments.
Right, right. So everybody's pretty much bearish. I have to say we're probably the only people. I say we us lot here at the market timing report, and people that are actually very bullish on oil. But we do have a major window coming up around about the third week of August. The last 2 weeks of August, I think, are going to be very critical. So I expect to see some trend changes there. So that
Mm.
suggests to me that we might see an escalation of what's going on in the Gulf over there.
Yeah, yeah, yeah. I
So
mean,
yeah,
that's certainly possible. I mean, it's such a volatile region, and things are happening which you wouldn't have expected. So you wouldn't have expected direct attacks on Iran. I'm sure supported by the US. Well, the US was involved, but the initial attacks supported by the US, and without sort of China and Russia sort of intervening. I'm not sure we would have expected that at the start of the year.
there's certainly a very big military buildup that's discreetly taking place here in Britain. You can see that a lot of American aircraft have headed over to the main bases here. So it looks
Okay.
like
Well,
uh,
the US's air force is coming further west, further
yeah,
east, sorry,
yeah.
further
There's
east.
there's evidence to suggest that. Now I don't know if it's
Okay.
all exercises or whatever,
Yeah,
but
you're starting a rumor now.
yeah, starting a rumor. That's it. Yeah, that's absolutely right. So there might be something in it, there might not. So we'll see. But the other thing in terms of cycles is that we're also going to be 35 years. Now that's one away from 36. I know people say, "Oh, that's which cycle are you talking about?" But there is a 35-year cycle we don't talk about so often. And if we go to August and the beginning of August, 1st of August 1990, so 35 years ago is when
Yeah.
Saddam marched into Kuwait,
Hmm.
and that did see a
There
big
was a big
spike.
spike. Yeah, yeah.
Yeah, followed by
I,
dozens.
I, I was I was sort of I was referring to that kind of spike and unexpected and so on. That was at the end of the real estate cycle for that period, and that I would potentially look out for something like that. Not necessarily a massive bull run in oil prices like we got in 2007, 8. I mean, it's possible, of course, but maybe something more of that nature, a really short but very sharp move up, which would be it would cause quite a lot of anxiety, I would have thought, in the marketplace.
Right, yeah, and of course, night before last, we were up in London at the STA, and the energy specialist there was very bearish on oil, wasn't
Yeah,
he?
that's true. That's very
Yeah.
true. Hmm.
So we met a couple of weeks ago. No, actually, it's nearly 3 weeks ago in New York. How did you enjoy the Foundation for the Study of Cycles conference, where you were a speaker?
Yeah, it was a really good event. It's like 3 days in New York, just talking about various aspects of cycles and the outlook for different asset classes, people's different takes on things. I mean, it's quite interesting that people might be looking at cycles and might have very different forecasts. So it's always interesting to hear different perspectives. So I got a couple of things out of it. First is that there is such a rich variety of things you can study if you go down the route of studying cycles, and obviously you have for a number of years, and but it's always endlessly fascinating to hear other people's takes on it, and what they do with that sort of data and that information, what sort of forecasts do they make. That's sort of fascinating. The second thing is, I got the sense that there's quite a lot of interest outside of our sort of relatively refined circle of people who are kind of taking an interest in these sorts of discussions. Obviously, maybe not always necessarily members of the foundation, but there seems to be a general interest, and I think the foundation can serve that really well. And maybe one other thing is, I've not been in a gathering of that many people where we can instantly relate to each other on these sort of topics. You don't have to kind of persuade them of the existence of cycles. You can always immediately launch into a conversation about what they're sort of seeing and what they're studying and how it fits together and so on. So yeah, it was really good. I made some nice contacts, some of your sort of colleagues and friends, really good people, and I look forward to further discussions. And of course, I think a lot of them are quite interested in my take on the real estate cycle and where we are and the outlook and so on.
Yeah, so you mentioned you got some good takeaway points. Can you specifically tell us about, say, a couple of those or something like that?
Yeah, well, I mean, there was a very interesting presentation on the outlook for the Dow. I think it was the Dow, maybe it was the S&P. Um, and it brought together cycles and trend lines and price points and other things, the 100% extensions and so on, and made a very sort of bearish case for the next few years. It said you're really at a critical point and so on. And there's a lot of evidence to suggest that. It's just that it happens to be somewhat different to my sort of short-term outlook for the market. So I thought that's really interesting. I mean, it's very good to hear a different perspective, one that I don't necessarily agree with, but to see how people kind of put it together. And maybe that person is right. Maybe it is. We have reached the peak, and that things are going to turn quite bearish in the short term. But yeah, I mean, just to see how the arguments are constructed and the evidence is marshaled is sort of fascinating. And I very much enjoyed your talk as well. You kind of took us through a range of different cycles and how it all fits together. It's almost like putting a puzzle together. You even alluded to that earlier in your remarks about oil. You're saying, well, the cycle is suggesting X, so therefore this probably means Y will contribute to that cycle for things. Because you often find that events tend to occur in a way that helps the cycle to repeat, bizarrely enough.
Yeah, I mean, yeah. Well, thank you. Yeah, I wasn't fishing for any compliments there, but
I
we
even.
did look at that roadmap of what lies ahead for the
Yeah.
next 20 years and how you configure it and so on. But Yeah, I mean, just address oil, and I'll just talk a little bit more about the foundation and just let the folks know who are watching this. But oil, yeah, we had such a big set of cycles coming in around about April, May time that we were looking for a significant low, and those cycles were so big that there just had to be a trend reversal. That together with the other cycles do suggest that well, we're already up. Well, we were down at 54, aren't we? And I see as looking at the trading screen right now, I'm seeing oil is up 2.76 percent today right now on WTI 68.41 trading. So it's moved up quite a bit. There's a bit more
That's true.
interest.
Yeah.
Technically, it's just bounced off a trend line. But coming back to the conference. This whole idea is that, I mean, just so those of you who are watching, there were about 100 of us there, maybe just over. But we were blessed with some of the biggest names in the industry who came to support the whole event. And perhaps top of the list is Peter Borish. And those who you don't know, Peter is Peter was heavily involved with the foundation way back when, but he's Paul Tudor Jones's business partner, is his partner. They've been together for years. In fact, the story is that when Paul was developing his hedge fund or put it together, he wanted somebody that could really work with data. And that's where Peter came up, and they made an absolute winning team, one of the most successful hedge funds ever. So he came along, and then, we've got the who's who of indicators. Sherman McClellan and his son Tom came along, really honored. I think Sherman just turned 90, I think. And so, the McClellans of the McClellan oscillator. Larry Williams, the legendary trader, was there as well. Peter Eliades, well, Larry Williams, percentage R and a ton of other indicators, and Peter Eliades. And there were some really big names there. So it was really exciting to be in such
Yeah,
an
that's great.
environment. So for those of you who are watching this that were there, thank you so much for coming because you really made it a tremendous success. And we got a big shout, a big thank out, a big shout out, a big thank you to Dr. Richard Smith, who's under his vision, we've got the foundation going again, and really ably supported by Bill Rooney and the team there. But the whole foundation board worked very hard and some great presentations. And I'd just like to come in. There was a guy who was looking at dopamine cycles
Oh yeah.
relating to solar patterns and how he related that to the behavior of markets. And I thought that was a tremendous presentation, and it was one that was very proven. He was sponsored there by Ray Tomes. We've got to mention Ray Tomes, who got a lifetime award for all his work here. Ray couldn't make it up from New Zealand due to the geopolitical climate, but that was a tremendous presentation. So it wasn't just like, what you see on Zoom when we do our meetings every few months. It was a really deep dive into what was going on there and looking at a whole different series, a lot of stuff on space weather, solar flares, the importance of those, as well as market forecasting. And what else do we have? Obviously, you brought in the real estate cycle there very nicely. That was great. And we also, I tried to bring some human behavioral cycles there as well. So it was a good event. So watch out for the next one because I think we are going to have another one.
I was going to ask that. Is that a possibility?
Yeah, let's do it. Let's make our minds up now. In fact, yeah, actually, so when we were having a drink night before last, we were talking about putting together some involvement with the foundation in London because there's a lot of Brits here. So if you're interested in that, let us know as well and get in touch either through the foundation or through you can certainly get in touch through our gang, the Market Timing Report, through the support team there. And we should start meeting maybe once a quarter, but we did find some nice venues, and I think there's a lot to talk about. So yeah, that would be great. So I think we should definitely have another one. Maybe we have a big conference in London. It's a case of whether all the Americans want to fly over or whether we've got to go back to New York. Firms invited us all over to New Zealand as well.
That'd be good.
But
Somewhat far.
yeah, so that was pretty exciting. And yeah, what else can we bring into the mix? You got married, right? So congratulations to you.
I
Yeah, so
did.
all the ladies
Yes.
watching us are going to be disappointed now. Um,
I think completely indifferent probably, but
what else? How's things going at property share market economics?
yeah, going very well. We have a nice bunch of subscribers, very engaged, always asking good questions, have sort of really kind of got into the whole sort of 18-year cycle and what it might means. And what they need to do about it, how they can prepare. So we've basically, in a sense, for those who follow our work, we've done our job in that we've got people thinking about the future and not getting carried away at these sort of times of the cycle, thinking about how they can best position themselves. It now remains to be seen, the timing of the peak and then what happens and where it might start and so on. So we've got a lot of pretty hard work ahead of us in the coming years, to really sort of identify these things, help people stay safe, take advantage of the downturn if as best they can. I'm not, I displayed the sort of relatively simple diagram earlier in this conversation, and I might have made it seem quite simplistic and easy to kind of forecast and all that sort of thing. And in a sense, it is, but I don't mean to suggest it is particularly easy in the moment. There's a lot of noise out there. While the cycle repeats, it doesn't repeat in the same way. So you've always got to be, have your eyes and ears open. That takes quite a lot of effort. It takes a lot of emotional stability, which is, quite difficult when you're also an investor. You're not just a dispassionate commentator. So, people always ask me, are you putting your money where your mouth is? You following your own advice? And of course I am. But the downside of doing that is you could argue you lose a bit of objectivity because you're also thinking about your own sort of portfolio and that investing is an emotional business, as you know. Bottom line is very excited for the next few years. We've been talking about the end of the cycle for well over a decade. We're now almost there. It'd be interesting to see what transpires. And with your publication, Market Timing Report, I know you've had a sort of new look, and I always really like your commentary at the start of each edition. I love the cycle, as you might imagine. I love that when you bring in the cycles and so on. Obviously, the foundation of it is the sort of the turning points and the pivot dates and so on. But this sort of broader cycle commentary is really fascinating.
Well, thank you. Yeah, one of the things we did think, I really did think there was quite a strong threat to Trump in June, and of course that manifested. He wasn't physically attacked, but it did manifest in terms of Elon Musk, almost undermining him there, and then moving into a global threat with America participating exactly in that window on the bombing raid on Iran. So I think that area is still going to stay hot. Of course, whilst we're here to forewarn people about geopolitical cycles from which they can, A, protect their assets and B, take advantage of those scenarios. We also are very much into helping everybody trading and investing. And on that note, actually, I'm very excited. We've just brought the last and final update into our advanced seasonality, our AI-based platform that is creating some tremendous opportunity. Well, it's creating a lot of tremendous opportunities. So that's just about to, it's already been out soft launched and we're just about to launch that. That's a very affordable product that's delivering tremendous returns, 970% of the trades are accurate. Obviously, you've got to manage the risk on them. You've got to have a trading system, but we're very excited about that. And the commitment of traders data is showing some really interesting things. As I mentioned, the British pound's on that radar. There's one particular commodities on that radar, sugar. I'm looking at that. I think there's some really interesting activity going on there, as well as a few other opportunities. So I definitely think we're in exciting times. I also think we're in dangerous times. And what I mean by that is that, for those of you who are trading and investing, make sure you know what you're doing. Have a system that works for you and make sure you're protecting the risk. So that's all the stuff. We'd cover that in our trading course as well. So it's all there. And I'm excited to be taking you all up to the next level. So what else can we say? Yeah, we've revamped the website. We've revamped the report. We've got a new look. So I hope you all like that. It's coming up to that time where we probably should be lighting up the barbecue. So I think that's
Great weather for it.
Yeah, yeah. A very impromptu. This was just decided. Well, 46 hours ago. In fact, literally 46 hours ago, we met up for a quick drink before going to the meeting. And I think, I'd been in meetings with banks and hedge funds all day. I think you've been busy as well with your stuff. So we just said, let's jump on. And it was kind of like, well, let's get the diary out. And then next thing is before you know it, you're 2 months down the road. So it's been very impromptu. Hope you've enjoyed it. Akhil, thanks for coming along. If you guys are watching this, want more of this, just let us know, because we're not afraid to jump on Zoom at 10 minutes notice and give you our very opinionated thoughts, whether you want them or not. But thanks very much for watching this. Akhil, good to see you. Congratulations on your wedding. Congratulations on everything you're doing. And we'll catch up soon.
Thank you.